Hi, I'm Doug Carroll. Welcome to Bond Math Basics Bond Pricing. This program has been designed to familiarize viewers with the concepts underlying bond pricing and evaluation, as well as to provide an introduction to industry standard methodologies for calculating bond prices for both trade and settlement purposes. Before beginning a detailed discussion of the topic, let me give you a preview of what to expect over the course of the session. We'll begin with a review of the fundamental concepts of bond pricing and related terminology. As we'll see, there are a variety of ways to express a bond's value. We'll introduce several, but our focus will be on prices expressed in currency units. Dollars will be used in the examples here, but the same concepts apply no matter the currency in which the bond is denominated, be it yen or pound or euro or whatever. The bulk of the session will focus on calculating prices using appropriate bond market conventions and the associated industry jargon. First, we'll price the simplest fixed income structure, single cash flow instruments known as zero coupon bonds or Treasury strips. The same pricing concepts will then be applied to more typical fixed income securities, reviewing the pricing of coupon bonds for trades settling both on and between coupon payment dates. In the latter situation, accrued interest will be addressed, which will be put into context with a discussion of day count conventions and clean price versus dirty price. There are many ways to express bond values. Fixed income securities can be quoted on a yield or interest rate basis. Money market instruments like T-bills are usually quoted in that fashion. Even bonds whose values are normally expressed on a price basis can have their value expressed in terms of their yield to maturity. Yield to maturity is the name given to the interest rate that expresses the current value of a bond. Unfortunately, yield to maturity is a widely misinterpreted concept, a problem which is exacerbated by the word yield being subject to a number of different interpretations. The specific meaning of the word yield is only discernible by the context in which it's used, and that presumes an author or speaker is cognizant of the multiple meanings and is choosing the words carefully. However, here our concern is quite straightforward. Determine a bond's price given its yield to maturity. Naturally, if a bond is quoted on a rate or yield basis, both the buyer and seller need to interpret the quoted yield the same way. The buyer needs to deliver the amount of money the seller is due, otherwise the trade will fail. We'll discuss and illustrate pricing bonds given their yield to maturity. Fixed income securities can also be quoted on a percent of par basis, with the pricing increments expressed in either decimals or fractions. Those methods of expressing value are covered elsewhere. Here we'll consider price in currency units. The illustrations are in dollar amounts, but the concepts described here apply regardless of the currency in which the bond is denominated. That still leaves quite a bit to discuss. Let's first distinguish between price and value, then we'll consider the different prices of a bond and related terminology. When discussing bond pricing and valuation, many related terms are tossed around, which can create much confusion for those not familiar with bond market jargon. Consider the following terms: price, value, market price, clean price, intrinsic value, flat price, estimated fair value, and quoted price. Let's sort through these terms and try to make some sense of them. First, let's consider price versus value. While someone new to the securities business, as well as some basic book writers, price and value sound like two ways of saying the same thing, fixed income professionals could possibly interpret the two differently. Unless, of course, one is using value as shorthand for market value, which is price by another name. To fixed income market professionals such as bond traders or fixed income portfolio managers, price and value do not always connote the same thing. In fact, much research is devoted to finding mispriced securities, that is, bonds trading at prices above or below their true worth or fair value. Naturally, if you have money to invest, you'd like to buy a bond at a price below what you believe it is truly worth, below its fair value. Trading cheap, in other words. Or, if you need to sell bonds from a portfolio, ideally it could be at prices above what you believe the bonds are truly worth. Trading rich in the parlance of the business. To a fixed income investment professional making a distinction between price and value, price would mean the dollar amount at which a trade was or could be executed. That is an execution price or quoted price. Value would refer to the amount an investor believes a bond should or will trade at in normal market conditions once all factors affecting risk and expected return are accurately assessed. Price is generally synonymous with market price, market value, flat price, clean price, and quoted price. Value is often shorthand for estimated fair value or sometimes intrinsic value. Let's consider the implications of any significant divergence between price and fair value. An approach known as rich-cheap analysis provides a framework for uncovering any difference between the two. Think about the distinction we've just made between price and value. We'll review the mechanics of calculating the two later, but let's here consider the consequences of any divergence between them. Though an in-depth treatment of valuation models is beyond the scope of this presentation, there are widely accepted methodologies for estimating the fair value of some debt securities, such as U.S. Treasury bonds or notes. After we explore bond pricing conventions in some detail, we'll address at a conceptual level a common method for estimating the fair value of a Treasury security. But given that such models exist, let's look into an application in the context of a rich-cheap analysis. If we apply the model to assessing the value of a selection of Treasury securities, most of the time a majority of the Treasuries will likely trade at prices very close to their estimated fair values. But occasionally, usually only for a short period of time, specific issues will have prices diverging from the fair values estimated using these models. A Treasury security's divergence from fair value might result from conditions in other fixed income market sectors or related derivative markets. For example, a security might be considered on special in the repo market, or a security might be the cheapest to deliver against a futures contract. If the market price of a security exceeds its estimated fair value, the security is trading rich. Unsurprisingly, an investor holding a security trading rich could add incremental return to their portfolio by selling that security and reinvesting the sales proceeds in another security trading at fair value. An investor with funds to invest ideally would like to find a security trading at a price below its fair value. That is, a security trading cheap as a way of adding incremental return. These divergences from fair value are usually relatively short-lived, more likely minutes to hours or days rather than months or years. Therefore, short-term traders must tread more carefully, as there is no guarantee that a security's price won't trade even further away from fair value before the two converge. But long-term investors have time working on their side. In fact, the only reason an investor should not sell a bond they hold, which is currently trading rich, or not immediately investing available funds in a security trading cheap, is if the investor has reason to believe any divergence from fair value is likely to widen further. That insight is beyond what a typical valuation model can provide, an insight that is available only through a qualitative analysis that looks at the story regarding that specific security or sector. Let's now move on to bond pricing. By pricing, I am referring specifically to the industry standard conventions for calculating the price of a security given the yield to maturity at which it is trading. We'll price several types of securities under a variety of circumstances. The pricing illustrations begin with the most basic sort of security, single cash flow investments, which are called zero coupon bonds or Treasury strips. After introducing basic pricing conventions in that simplest of contexts, the discussion will turn to the more commonly encountered type of instrument, fixed coupon bonds. Initially, we'll price them for trades settling on a coupon date when there is no accrued interest. Then we'll move on to the more likely situation for trades settling between coupon payment dates, which necessitates the determination of accrued interest. In that context, we'll introduce how fixed income markets account for the passage of time, the so-called day count conventions, as well as the related jargon of clean price versus dirty price. Here we see the formula for computing the price of a zero coupon bond or Treasury strip. The price is the present value of the single cash flow discounted by the yield to maturity over the time to maturity. We'll dig into the specific details of the formula in just a moment. Before we go into the details of pricing, however, let me explain the diagram at the bottom of the page. Such diagrams are often used to illustrate the cash flow dynamics of securities or derivatives. The horizontal axis is a timeline, the length of which indicates the time to maturity, with the time increments expressed in coupon or compounding periods. Down arrows indicate cash outflows, up arrows cash inflows. The down arrow at the far left end of the diagram, at time 0, indicates the price paid by the investor at purchase. The only up arrow in this example is at the far right end of the timeline, the bond's maturity. That up arrow reflects the payment of the full face amount, the only cash flow due to the investor holding a zero coupon security. If this diagram had been for a coupon bond, there would have been shorter up arrows at the end of each time increment indicating the amount of the periodic coupon payment. We'll see an example of that in just a few moments. Here you see reprised the formula for pricing a zero coupon bond or Treasury strip. Again, the formula calculates the present value of the single cash flow to the investor, the face amount at maturity. So let's dig into the details of the formula. The I in the denominator is a reference to the interest rate that will be used to discount the future cash flow back to a present value or price. Realize that the interest rate used in the formula is not likely the quoted interest rate, at least for any U.S. issued fixed income security. The convention for quoting interest rates is to do so on an annualized basis. Nonetheless, when computing value or cash flow consequences, it's typically necessary to use the periodic rate, which is the annual or quoted rate divided by the number of compounding periods per year. Now consider the exponent in the divisor. The exponent expresses the amount of time until the receipt of the cash flow being discounted, with time measured in coupon or compounding periods. Consequently, if the time to maturity is given in years, it would be necessary to multiply the number of years by the number of compounding periods per year. For example, if there were 5 years to maturity for a semi-annual compound security, that would be a total of 10 periods until maturity. Alternatively, for a monthly pay instrument, such as a mortgage-backed security, in 5 years there would be 60 compounding periods. That is the 12 monthly periods per year times the 5-year time horizon. For those unfamiliar with fixed income market conventions, it might seem like compounding frequency is a non-issue for zero coupon bonds, as there are no periodic coupon payments. However, bond market pricing conventions require the use of the compounding assumption for coupon securities from the sector. So even though Treasury strips have only a single cash flow at maturity, since Treasury bond and note coupons are payable twice annually, semi-annual compounding, or for pricing purposes discounting, is appropriate for pricing Treasury strips. Given these market conventions, let's price a zero coupon bond using the following information. A $100,000 par value security that matures in exactly 10 years, trading at a yield to maturity of 2.6% or 0.026 in decimal terms. Since this security is priced using semi-annual compounding, even though the quoted yield is 2.6%, that annualized yield quote needs to be converted into a periodic rate. Dividing the annual yield of 2.6% by the 2 compounding periods per year leads to a periodic rate of 1.3% or 0.013 in decimal terms. As the security has 10 years to maturity, but is from a market sector that uses semi-annual compounding, one must multiply the 10 years by 2 to convert the time until the receipt of principal to 20 semi-annual periods. With those conversions, we can now flesh out the right-hand side of the formula, which will allow us to calculate the bond's price. Take the $100,000 par value, divide that by 1 plus I, that is 1 plus the periodic rate, or a divisor of 1.013, where that 1.013 needs to be raised to the 20th power to reflect the fact that there are 20 semi-annual periods over the 10 years to maturity. First, raise that divisor to the power, then divide that result into 100,000. That calculation determines the market price of the 10-year Treasury strip, trading at a yield to maturity of 2.6%. A price of $77,234.46. That's the amount an investor would pay today to receive $100,000 in 10 years. How about coupon bonds? In what ways does the pricing of coupon bonds differ from the methodology for determining the dollar price of zero coupon bonds? Really, there is no difference in the methodology. Pricing coupon bonds employs the same methodology that was applied to the single cash flow on a zero coupon bond, but applies it to each of the individual cash flows on a coupon security. So to price a coupon bond, each of the cash flows is discounted by 1 plus the yield to maturity, expressed as a periodic rate. For each of the cash flows, the divisor, the 1 plus I, needs to be raised to a power that reflects the amount of time, expressed in coupon periods, until the receipt of the cash flow being discounted. The price is nothing more than the summation of the present values of the future cash flows discounted in that fashion. You see the formula expressed in symbols near the bottom of the page. On the left-hand side of the equation is P for price. On the right-hand side of the formula, there are separate elements for each of the individual cash flows. The numerator of each of the elements on the right-hand side includes a C with a subscript, which indicates the ordinal sequence of the cash flow. C sub 1 indicates the next due coupon, C sub 2 the second due coupon, C sub 3 the third due coupon, and so forth and so on. The numerator of the last element on the right-hand side of the equation is for a cash flow that is comprised of C sub n for the nth or final coupon, along with the par value which the bondholder would receive at maturity. This is the formula for pricing term bonds, which is the name of bonds where all the principal is due at maturity. This is the most common structure of debt issues in the corporate, municipal, and government bond sectors of the U.S. bond markets. On the right-hand side of the equation, each of the cash flows is divided or discounted by 1 plus I, where I is the yield to maturity expressed as a periodic rate. Recall the periodic rate is the quoted or annual yield divided by the number of compounding periods per year. Since each of the following examples illustrates the pricing of semi-annual pay bonds, the adjustment to the discount rate is the same as was employed previously in our zero coupon bond pricing example. Divide the given yield to maturity by 2 to determine the periodic rate. Let's look at a specific example to more fully understand the pricing methodology. But before we do that, consider the diagram at the bottom of the page. What we see here is a line diagram that's a counterpart to the similar diagram that was introduced during the pricing of zero coupon bonds. Again, the horizontal axis represents the time to maturity, segmented into coupon periods. The down arrow at time 0 indicates the price paid by the buyer. Up arrows indicate cash flows to the bondholder. Like the previous version of the diagram, a large up arrow at maturity indicates the return of the principal at that time. The new element in this version of the diagram are the smaller up arrows at the end of each segment, indicating the periodic coupon payments. Using the formula introduced on the previous page, let's price a $1,000 par value bond. Assume the bond to be priced has exactly 3 years to maturity, carries a 5% annual coupon, payable semi-annually, and is trading at a 6% yield to maturity. A bond's price is the present value of the future cash flows discounted by the yield to maturity expressed as a periodic rate. Let's see mechanically how those ideas come together to determine this bond's price. First, consider the cash flows. In symbols, that's C sub 1, C sub 2, C sub 3, etc. Since we're pricing a 3-year semi-annual pay bond, we would expect a total of 6 coupons over the time to maturity. Given the bond has exactly 3 years to maturity, the first coupon is due in 6 months, the second coupon in a year, the third coupon a year and a half, and so forth and so on, until at the end of 3 years when the bondholder would receive the final coupon plus the principal. Compute the amount of the periodic coupons by multiplying the par value by the coupon rate. So by multiplying $1,000 by 0.05, that's 5% in decimal form, gets the bondholder $50 a year in annual coupon payments per $1,000 par value. Since this is a semi-annual pay bond, each of the periodic coupons would be for $25. The final cash flow would be $1,025, which is the sum of the final coupon payment of $25, along with the $1,000 of principal. The bond's price is the present value of the future cash flows, the coupons and principal, discounted by the yield to maturity expressed as a periodic rate. The quoted yield to maturity of 6% would be divided by 2 to get a periodic rate of 3%. So each of the divisors must be 1.03. Then each of those divisors needs to be raised to a power that reflects the amount of time until the receipt of the cash flow being discounted. Note in this example, the exponents are full integer values. The first coupon is discounted by 1 plus I to the first power, the second coupon by 1 plus I to the 2, and so forth and so on. Be careful with the interpretation of the subscript on the coupons versus the exponents in the divisors. They are the same in each element on the right-hand side of the equation, but that's a function of this particular example. In general, the subscripts and exponents are referencing different issues. The subscripts on each of the cash flows are simply referring to the sequence in which the cash flows are received. Beyond that, they have no specific implication, just the ordinal ranking of the individual cash flows. The exponents in the divisor, however, imply the exact amount of time until the receipt of the cash flow being discounted, with time expressed in coupon periods. Let me be completely clear about the implication of the divisor in the first element of the 1 plus I under C1, which is raised to the first power. The 1 implies there is exactly 1 coupon period until the receipt of the first coupon. The fact that the second coupon is divided by 1 plus I raised to the second power would imply that the second coupon is to be received in exactly 2 periods, and so forth and so on across the entire array of cash flows we'll use to price this bond. For a bond trading between coupon payment dates, the divisor of the first coupon would be raised to a power of less than 1, as there would be less than a full coupon period till the receipt of the next due coupon. And there would need to be a similar adjustment to the divisors and the exponents of all the subsequent cash flows. That doesn't arise in this example, as the bond has exactly 3 years to maturity. A later example will look at the complications of a bond trading between coupon payment dates. But given this bond has exactly 3 years to maturity, assuming normal coupons, the first coupon is due in exactly 1 period, the second coupon in exactly 2 periods, the third coupon in exactly 3 periods, and so on. Consequently, in this case, it's appropriate that each of the exponents would be a round integer value. The price of the bond is the present value of the future cash flows. The formula now detailed in numbers shows how we would compute the present value of each of the individual cash flows. And the price is nothing more than the summation of the present value of the individual cash flows, again discounted by the yield to maturity expressed as a periodic rate, with each divisor being raised to a power that reflects the amount of time until the receipt of the specific cash flow we're computing the present value of. So consider each coupon in turn. The first coupon, $25 divided by 1.03, would get us a value of $24.27. Yes, the first coupon payment will be for $25, but the payment is not due for 6 months. The present value of $25 in 6 months, discounted by the 6% yield to maturity, is only $24.27. The present value of the second coupon is $23.56. In this case, we're dividing the $25 coupon payment by 1.03 squared, reflecting the fact that the second coupon is due in 2 periods. Naturally, even though each of the coupons is for the same dollar amount, and we're discounting each by the same discount rate, the present value of each subsequent coupon will be smaller and smaller, given that we're discounting each of the subsequent coupons over a greater number of periods. As this is a term bond, the cash flow with the largest present value would be the final cash flow, since along with the final coupon payment, the bondholder would receive the full principal amount. By adding together the present value of the individual cash flows, we come up with a dollar price of $972.91. What about pricing a bond for a trade that would settle between coupon payment dates? Let's consider the consequences using the bond from the previous example with one alteration to the scenario. Assume 2 months have passed, so what had been a 3-year bond is now a bond that has only 2 years and 10 months until its maturity. Consider the 3-year bond we just priced. Here again is the bond price formula we just worked through when it was a 3-year bond. What will need to be changed on the right-hand side of the formula to determine the correct price now that circumstances have changed? What's different from the previous example? No cash flows have been received. When it was a 3-year bond, there were 6 months until the first coupon was due. Since only 2 months have passed, there are still 4 months remaining until the first coupon becomes payable. The bondholder is still due the same number of cash flows for the same dollar amounts. The scenario assumes the bond is still, or again, trading at a 6% yield to maturity. So what has changed? What's different in the altered scenario? The only thing that has changed is the time remaining to maturity. And recall how time is reflected in the formula. Time appears only as the exponents in the denominators, reflecting the time until the receipt of the cash flow in the numerator being discounted, time being expressed in cash flow or compounding periods. The example assumed a semi-annual pay bond with regular coupon payment dates. Since the bond now has 2 years and 10 months until maturity, the first coupon is not due for another 4 months. The same number of cash flows for the same dollar amounts are still owed to the bondholder. And the discount rate remains the same, a periodic rate of 0.03 from 0.06 divided by 2, as the bond is assumed to be trading at a 6% yield to maturity. Only the exponents need to be adjusted to reflect the fact that each cash flow is now 2 months nearer receipt. As there are 6 months in a coupon period for a semi-annual pay bond, there would be 4/6, or reducing to the lowest common denominator, 2/3 of a coupon period remaining until the first coupon payment is due. Given that there are only 2/3 of a coupon period until the receipt of the first cash flow, to find the present value of the first coupon payment, we would need to divide the $25 amount of the first periodic coupon by 1.03 raised to the 2/3 power, reflecting the fact that there are only 2/3 of a coupon period remaining until the cash flow is due. The determination of the exponents is actually a bit more complicated, as fixed income markets express time on the basis of various day count conventions. 30 over 360, actual over 360, or actual days being the most common for U.S. issued debt securities. The mechanics of those day count conventions and their impact on pricing will be addressed in more detail later in the session. This example will use 2/3 to illustrate the concept. Of course, changing the exponent on the first divisor isn't the only adjustment that needs to be made. Since 2 months have passed, all of the cash flows are 2 months near receipt. Consequently, the exponents on each of the divisors must be adjusted to reflect that fact. As the first coupon is due in 2/3 of a coupon period, all subsequent coupons are due in 2/3 plus 1 period more than the preceding coupon. Therefore, the second coupon is now due in 1 2/3 periods, the third coupon in 2 2/3 periods, and so on across all cash flows through the final coupon and principal at maturity. For that final cash flow, the divisor would be raised to the 5 2/3 power, reflecting the 5 2/3 coupon periods remaining to maturity, which is just a convoluted way of expressing the 2 years and 10 months remaining in the bond's life. Pricing the bond requires we sum the present value of all the cash flows. So the first step would be to calculate the present value of the individual cash flows with the appropriate adjustments to the exponents. Altered to reflect correctly the timing of the cash flows, the present value of the coupons and principal is $982.55 per $1,000 par value. Is that the price of the bond? As in the pricing example when there were 3 years to maturity, we have calculated the present value of all the cash flows. But is the $982.55 calculated here as the present value comparable to the $972.91 market price calculated previously when 3 years remain until maturity? No, the $982.55 is not what market participants would understand as the price. To market professionals, price is usually shorthand for market price, also referred to as flat price or clean price. Discounting the cash flows on a bond traded between coupon payment dates calculates the full value of the bond, commonly referred to as the dirty price, which is the market price plus the accrued interest. Let's explore the issue of dirty price versus clean price and the day count conventions. The present value of the cash flows in the previous example is not subject to the same interpretation as the dollar price we calculated for the 3-year bond in the original example. It's a consequence of a trade settling between coupon payment dates. When a trade settles on any day other than a coupon payment date, the settlement value would reflect the price agreed by the buyer and seller, plus an adjustment for the portion of the next due coupon earned up until the settlement date of the trade. Or in other words, the buyer owes the seller the market price plus the accrued interest, also known as the dirty price. Fixed income markets use a number of different ways of accounting for the passage of time. Thus, there are a number of different methodologies used to determine the amount of accrued interest. Different conventions are used by the different sectors of the U.S. fixed income markets and various markets around the world. The 3 most widely used day count conventions in the U.S. fixed income markets are 30 over 360, actual over 360, and actual days. The 30-360 convention assumes every month is 30 days in length, regardless of the actual number of calendar days. Naturally, a year of 12 30-day months leads to a 360-day year. If you ever encounter the phrase commercial year when reviewing the terms of a debt contract, commercial year is the formal expression of the day count convention for which 30-360 is the industry shorthand. Another widely used day count convention is actual over 360. Actual over 360 counts the true number of calendar days, but still assumes a 360-day year. Why do those 2 day count conventions assume a 360-day year? It's mostly a result of the primitive technology of the pre-calculator, pre-computer ages. 360 was a much easier number to divide by than the 365 or 366 actual day length of the year when the division is being done longhand. Now, of course, we have access to advanced technology, so one might wonder why rely upon a seemingly antiquated method for determining the passage of time. As it turns out, there are no ideal day count conventions. They all have their particular quirks. Aside from that, think of the huge quantity of legal contracts that would need to be rewritten and the untold lines of computer code that would have to be recoded if all contracts were converted to actual days. The other major convention is actual days. It is also sometimes referred to as actual over actual. This presentation puts it on a common footing with the other two conventions, which are expressed as something over something. Also, it is the way the day count manifests itself in the accrued interest formula, the actual number of days of accrued interest divided by the actual number of days in the coupon period. Here we see some details regarding the day count and compounding conventions used in various sectors of the U.S. fixed income markets. As you can see, the 30 over 360 day count convention is used in a majority of the sectors. Corporate, municipal, and government agency debt, mortgage-backed and asset-backed securities, as well as collateralized debt obligations all use this count. Actual over 360 is used for all U.S. issued money market instruments, which are generally defined as securities with a year or less to maturity from their date of issuance. U.S. T-bills also use this convention. So even though U.S. Treasury bonds and notes use yet another day count convention, bills are done in a fashion consistent with other short-term debt instruments. Actual over 360 is also often used for instruments whose interest rates adjust over time, such as floating rate notes or the floating rate leg of interest rate swaps. T-bonds and T-notes use actual days or actual over actual. Many books mistakenly express the day count convention for Treasury securities as actual over 365. There is such a day count convention, it's just not the one used for U.S. Treasury securities. As we will see later when illustrating the computation of accrued interest on Treasuries, the number inputs to compute the accrued interest are the actual number of days of accrued interest divided by the actual number of days in the coupon period. At first glance, it might seem that actual days and actual over 365 are two ways of expressing the same convention. But the two are distinctly different. For semi-annual pay bonds, actual over 365 assumes two coupon periods of equal length, 182.5 days each. Actual over 365 assumes equal amounts of accrued interest are earned day by day across the year. Actual days, on the other hand, results in different daily accruals in the two coupon periods. For most bonds using actual days, the day count splits 181, 184, although for some bonds it will split 182, 183. Therefore, in any non-leap year, even though each coupon is for 1/2 of the year's interest, it will be earned over a period of time that is either slightly longer or slightly shorter than 1/2 year. As for compounding conventions, semi-annual is the most common, used for the majority of corporate, government, and municipal securities. On the other hand, monthly is common in the mortgage-backed securities market, reflecting the typical frequency of payment on the underlying mortgage loans. Quarterly is encountered with some frequency on floating rate notes and many fixed income related derivatives such as credit default swaps and interest rate swaps. While it is not the norm for any common type of U.S. issued debt security, dollar-denominated bonds issued outside of the United States, so-called Eurodollar bonds, follow the conventions common in continental Europe and thus use annual compounding. Let's investigate day count conventions in the context of calculating accrued interest and use that as a nexus for revisiting the issue of clean versus dirty price. First, let's calculate the accrued interest on a corporate bond, a bond that uses the 30 over 360 day count convention. At the top of the page, you can see an abbreviated bond description. So we'll calculate the accrued interest for a $100,000 par value bond from the infamous XYZ Corporation that has a 4 3/4% coupon rate, matures sometime in the year 2024, and is currently priced at 95% of par. We'll assume the bond was issued on the 15th of February 2009 to mature on the 15th of February 2024, so a bond with 15 years to its maturity at the time of issuance. The coupon payment dates are every February and August 15th until maturity. The example assumes a trade date of Monday the 17th of June 2014. To calculate the amount of the semiannual coupons, take the par value of $100,000, multiply that by the coupon rate of 4 3/4%, or 0.0475 in decimals, and in turn times the length of the coupon period as a portion of the year. By this day count convention, the assumed 180-day length of the coupon period would be divided by the 360-day assumed length of the year. That would imply semiannual coupon payments of $2,375 every February and August 15 through the February 2024 maturity. Whomever holds the bond as of the coupon payment date receives the entirety of the coupon, even if the bond was not held for the full length of the coupon period. The calculation of accrued interest is used to determine what amount of the next due coupon is to be paid to the seller. The determination of that amount requires a count of the days of interest accrual, which depends upon the date the ownership of the bond changed hands. The information provided is the trade date. What's needed is a settlement date. Of course, the trade date is important. That's the day the buyer and seller agree to the transaction at a specific price. But the date that's important for purposes of interest accrual is the day upon which the beneficial ownership changed hands, the settlement date. For normal transactions in corporate securities, referred to as regular way trades, the settlement date would be T+3, that is the third business day after the trade date. Since there were no holidays that week, a trade executed on Monday, June 17 would settle on Thursday, June 20, the third business day after the trade date. So the seller is due the accrued interest that started accruing on the last coupon payment date, continuing up to but not including the settlement date of the trade. Note how the diagram was drawn. It tries to indicate as precisely as possible the implications of the preceding words. See how the seller's interest in the August coupon starts to accrue on the February coupon payment date, the 15th of February. The coupon payable on the 15th of February is for interest earned through the 14th of February. On the 15th of February, the date the February coupon becomes payable, next August's coupon has already started to accrue interest. So the count for the seller begins on the last coupon payment date. The seller's accrual includes all of the days up to but not including the settlement date of the trade using the 30-day month convention. While the buyer would receive the entirety of the coupon payable on August 15th, assuming they hold the bond through that date, clearly the buyer is only deserving of that portion of the coupon that started to accrue as of the settlement date of the trade. But as the buyer will be receiving the entirety of the coupon if they hold the bond that long, at the time the trade settles, the buyer has to pay the seller not only the price they've agreed, in this example the 95% of par, but also compensate the seller for that portion of the next due coupon that was earned up to the settlement date of the trade. Once we've counted the number of days of accrued interest, that would be plugged into the formula at the bottom of the page that takes the number of days of interest due the seller, divides by the length of the year, 360, and in turn multiplies that by the coupon rate of 4 3/4%, and then times the par value of 100,000. So you can see the count rendered in the lower left-hand corner of the page. Remember, each month is 30 days in length. So in February, we're counting the 15th through the 30th inclusive, which is 16 days. March, April, May all show as 30 days. That is inconsistent with the calendar, but appropriate as this day count convention assumes 30 days as the length of every month, no matter whether the calendar length be 28, 29, 30, or 31. In the month of June, the day count will run up to but not include the settlement date. Since the trade settles on the 20th, the seller will have earned 19 days worth of accrued interest in June. So summing the days of accrued interest, that totals to 125, plugging that into the formula along with the other details, we see that the dollar amount of accrued interest in this case would be $1,649.31. Let's now illustrate the accrued interest calculation for a bond that uses the actual day count convention. To the extent possible, this example will be similar to the previous one. We'll again assume a $100,000 par value security with a 4 3/4% coupon rate. However, in this example, it's a U.S. Treasury bond as opposed to the corporate bond from the previous example. To make the examples as comparable as possible other than different issuer, the security has all of the same terms, so the same maturity date, 15 February 2024, as well as the same coupon payment dates of February and August 15. So to a large degree, this example is similar to the previous one. Coupon payments of the same dollar amount due on exactly the same day, and this example also assumes a trade date of Monday, June 17th. However, despite all of the similarities with the previous example, there will be significant differences. Treasury securities use different day count and settlement conventions than corporate securities use. Unlike corporates, where regular weight trades settle on the third business day after the trade date, or T+3, regular weight trades in Treasury securities settle next business day, or T+1. So given a trade date of Monday, June 17, a regular weight trade in a Treasury bond would settle on the next business day, Tuesday, June 18. Again, the seller is earning the accrued interest that started accruing as of the last coupon payment date and runs up to but not including the settlement date. In this case, the count is of the actual number of calendar days over that time frame. The day count will differ both because of the different amount of time between trade and settlement, as well as a different way of counting the days. The day count entails more than just the number of days of accrued interest due the seller. The actual number of days in the coupon period must also be determined. Once the days of accrued interest has been counted, then count the days in the balance of the period. The formula for computing the accrued interest on treasuries is shown in the lower right-hand side of the page. It's the actual number of days of accrued interest due the seller, divided by the actual number of days in the coupon period, which is then multiplied by the coupon rate divided by 2, and in turn multiplied by the par value. A significant difference between this formula and the one used in the 3360 example is the division of the coupon rate by 2. That adjustment is necessary here because what's being computed is the portion of the coupon period over which the seller was accruing interest. The 3360 convention considers the portion of the year over which the seller was accruing interest, so the formula uses the fraction of the year over which interest was accrued times the full annual coupon. That is the coupon rate times the principal, or par value. The actual day convention computes the portion of a coupon period, which would then be multiplied by the dollar amount of the coupon payment, which is the result of the other elements in the formula, coupon rate divided by 2 times the par value. The count of the days is shown in the lower left-hand corner of the exhibit. Since 2014 was a non-leap year, the February count runs from the 15th through the 28th inclusive, which is 14 days for February. By the calendar, March has 31 days, April has 30 days, and May has 31 days. Then in June, the seller earns the interest up to but not including the settlement date of the 18th, so that means 17 days of accrued interest due the seller for the month of June, for a total of 123 days of interest accrual due the seller. More counting still. as the total number of days in the coupon period needs to be determined. Count the days from the settlement date up to but not including the next coupon payment date to get the days in the balance of the coupon period. June has a length of 30 calendar days. There were 17 days up to the settlement date, so from the settlement date onward there are 13 days remaining in June. July has 31 calendar days. In August, we accrue interest up to but not including the coupon payment date of the 15th, which means 14 days of accrued interest for the month of August. So totaling the days in the balance of the coupon period, we get 58. By adding that to the number of days of accrued interest due the seller, we have the length of the coupon period of 181 days. All the info to calculate the accrued interest has now been determined. 123 days of accrued interest divided by the 181 days in the coupon period times the annual coupon rate of 0.0475 divided by 2 to reflect the fact that we're accruing interest on one of the semi-annual coupons, and then multiplied by the 100,000 par value, all of which leads to accrued interest in this example of $1,613.95. Let's revisit the bond pricing formula, this time to see how the values used in the price calculation will be affected when applied to bond trades settling between coupon payment dates. Let's take the bond we had used to illustrate the calculation of accrued interest for the 3360 day count convention. The $100,000 par value XYZ 4 3/4 of 2024 priced at 95% of par. That's the bond for which we previously calculated accrued interest of $1,649.31 for the June 17 trade that settled on June 20. Assume the bond price reflected a yield to maturity of 5.4%. What is the present value of the cash flows? You see replayed here the generic bond price formula, which shows the price as being equal to the present value of the future cash flows, where the future coupon and principal payments are discounted by the yield to maturity expressed as a periodic rate. The dollar amount of each of the coupon payments would be $23.75. That's nothing more than the 4 3/4% coupon rate times the $100,000 par value divided by 2 to reflect the semi-annual coupon payments, a calculation shown previously. And of course, along with the final coupon, the bondholder would receive the $100,000 of principal. To find the price of the bond, we would need to discount the cash flows by 1 plus the yield to maturity expressed as a periodic rate. So since the annual yield was given at 5.4%, 5.4% divided by 2 gives us 2.7% as our periodic rate, or 0.027 to express the same in decimal terms. So each of the divisors are rendered as 1 plus that periodic rate, or 1.027. But what about the power to which each of those divisors should be raised? We're extending on the 3360 accrued interest example, so the coupon payment dates were February and August 15, with a trade occurring on June 17th and settling on June 20th. How would the details of that transaction impact the exponents to which we'll raise each of the divisors? Now the first coupon is due in less than a full coupon period, some fraction of the period. As all subsequent coupons are one full coupon period after the preceding coupon, all subsequent coupons would also be discounted using a divisor exponent that reflects the same fractional period in the time remaining to those coupons. We'll address the computation of those exponents shortly, but consider now the appropriate value for the left-hand side of the equation. Assuming the exponents were adjusted properly, what's going to be the present value of the cash flows? Will the present value of the cash flows be the $95,000 market price, or will the present value of the cash flows be the $96,649.31, which would be the market price plus accrued interest? Discounting the cash flows for a bond trade settling between coupon payment dates calculates the full value of the bond, which would include the accrued interest. So the right answer is the present value of the cash flows is equal to the dirty price, or the full value of the bond, the $96,649.31. Let's consider a bond's price versus the present value of the future cash flows. Most basic books define a bond's price as the present value of the future coupon and principal payments. That would usually not be consistent with the way most fixed income professionals understand the word price. When market professionals hear the word price, they normally associate that with market price. For semi-annual pay bonds, the present value of the future coupon and principal payments equals the market price only twice a year, when a trade would settle on one of the two coupon payment dates. For trades settling on any other day of the year, the present value of the cash flows equals the full settlement value, or in other words, market price plus accrued interest, or dirty price. That is not the meaning taken by most market professionals from the word price by itself. Bond market convention for coupon bond trades. Bonds are quoted flat but trade with interest. Quoted flat refers to values implied by bid or ask quotes or amounts negotiated between the buyer and seller. These amounts are variously referred to as the flat price, clean price, or market price. This is the meaning normally associated with the word price by market professionals. Trade with interest means that under normal circumstances, the buyer and seller assume that in addition to the price to which they've agreed, the settlement value will include the accrued interest as per industry standard conventions regarding day count and settlement. That settlement value is sometimes referred to as the full price, or more commonly as the dirty price. Naturally, there are exceptions. Some bonds are quoted flat and trade flat. That is, the settlement value is the agreed price, no accrued interest is to be added. Zero coupon bonds and bonds in default are two such exceptions. With zeros, there is no coupon to accrue. For defaulted bonds, if the issuer has not been paying coupons in the past, it would be inappropriate to price trades assuming payment of future coupons. Let's now consider the determination of the exponents in the divisors of the bond price formula. Remember, the exponents reflect the time until the receipt of the cash flow in the numerator, the length of time over which the cash flow is being discounted. However, the exponents express time not in years, but in coupon or compounding periods. In complicating things just a little bit further, the amount of time is rendered using the appropriate day count convention, either 30, 360, or actual days, depending upon the type of security. Let's illustrate some of those issues using the XYZ corporate bond from the previous examples. Let's revisit the bond pricing formula once more, this time to explore the mechanics of determining the appropriate exponent values. The illustration uses the same corporate bond as in the previous examples, the $100,000 par value XYZ 4 3/4 of 2024, priced at 95 and trading at a yield to maturity of 5.4%. The bond has coupon payment dates of February and August 15th. What are the appropriate exponents in the pricing formula for the June 17 trade which settled on June 20? In that situation, there was 125 days worth of accrued interest amounting to $1,649.31 included in the settlement value of that trade. Setting up the formula. The full value or dirty price is on the left-hand side of the equation. The 95% of par, or $95,000, plus the $1,649.31 of accrued interest. That is the present value of all the cash flows for the trade settling between coupon payment dates. The numerators on the right-hand side are the dollar amounts of the various cash flows. $23.75 for each of the periodic coupon payments, and $102,375 for the final cash flow. The divisors under each of the cash flows will be 1.027, the 0.027 being the periodic or semi-annual rate implied by the 5.4% yield to maturity. But what about the powers that each of those divisors must be raised to? From the information provided, we know that at trade settlement there were 125 days worth of accrued interest. Given the mechanics of the 3360 day count convention, most bonds with normal coupons will have coupon periods of 180 days. So if there had been 125 days of interest accrual up to but not including the settlement date, the time remaining in that coupon period, that is from the settlement date up to the date of the next cash flow, would be 55 days. That's the entire length of the coupon period, the 180 days, less the number of days of interest accrual, 125 days. So the exponent on the first divisor would be 55 divided by 180. Naturally, the divisor in the exponents is always 180, since what is being expressed is the number of coupon periods, and 180 is the assumed length of each coupon period. Since each subsequent coupon is one full coupon period after the preceding coupon, by the nature of the day count convention, there will normally be 180 days between each coupon payment date. So if the first coupon is due in 55 days, the second coupon must be due in 55 plus 180, or 235 days. Therefore, the exponent on the second divisor must be 235 divided by 180. The value of the numerator in each subsequent exponent is always the numerator of the previous exponent plus 180. So the third divisor would be raised to the 235 plus 180, or in other words, the 415 divided by 180 power, and so forth and so on, all the way out until the final coupon payment. Finally, let's return to the issue of bond pricing versus bond valuation. The formulas rendered in symbols on this page detail the two computations. The first of the two has been encountered frequently already in this program. It's the standard bond pricing formula, where the price is the present value of the future cash flows, discounted by 1 plus the yield to maturity expressed as a periodic rate, with each divisor raised to a power that reflects the amount of time until the receipt of the cash flow being discounted. The formula for estimating fair value has a substantially similar look. Of course, each of the numerators would have exactly the same values because we're trying to estimate the value of a contract that entitles the holder to receive those very cash flows. The denominators have a somewhat similar look. Each divisor is 1 plus I raised to the same power as in the pricing formula. The exponents in the estimated fair value formula have exactly the same implications as the exponents in the price formula and reflect the same timing of the cash flows. However, you'll note that in the formula for estimating fair value, there is a distinct difference in the divisors. Each of the i's, each of the periodic rates, carries a subscript. The implication is that fair value would likely be best estimated through discounting each cash flow by its own unique interest rate. Discounting by a single rate reflecting the yield to maturity is the convention for determining a bond's price. That's the convention for establishing the dollar price implied by yield quote so that all market participants interpret a yield quote to imply exactly the same market price. However, in trying to estimate fair value, it's unlikely discounting all the cash flows by the same rate would be appropriate. Valuing different cash flows with the same discount rate would seem to imply the same or at least a similar degree of risk associated with the different cash flows. For cash flows dispersed widely over time, it's very unlikely that the uncertainties related to issues such as credit risk or inflation are the same. Therefore, to estimate fair value, it's appropriate to discount each cash flow by a rate that's appropriate given the timing and risk of that individual cash flow. The implications of the subscripts are that one period cash flows should be discounted by one period rates, 2-period cash flows by 2-period rates, 3-period cash flows by 3-period rates, etc., etc., etc. You'll note that the line at the bottom of the page refers to each of those subscripted i's as the spot rate for that particular term. This is a common methodology for estimating the fair value of Treasury securities, that is, discount each of the periodic coupon or principal payments by a spot rate having a term consistent with the timing of that cash flow. This is a common approach for estimating the fair value of Treasury bonds or notes. Essentially, it views a bond as a package of zero-coupon securities. Valuing each of the cash flows separately, using an interest rate that's appropriate given the timing and risk of the cash flow, the summation of the values of the individual cash flows should be a reasonable estimate of a bond's fair value. That description sounds somewhat similar to bond pricing, but remember, when pricing a bond, we're discounting all the cash flows by a single discount rate that reflects the bond's yield to maturity. When estimating fair value, we're valuing each cash flow by, at least in most market environments, different interest rates, the spot rates having terms consistent with the timing of the cash flows that are being used to value. Comparing a bond's price to its fair value estimated in this fashion provides a basis for determining whether a fixed income security is approximately fairly valued, or if it might be trading above or below its fair value, that is, trading rich or cheap, as was discussed earlier in the program.